All right, everybody. We're going to go ahead and get started. For those of you that don't know me, my name is Ryan Melliker. I am president and co-founder of Lodging Analytics Research and Consulting, what we affectionately refer to as LARC. Before we jump in, a couple of things I want to highlight to everybody. Number one is this webinar is being recorded, and the recording will be posted on our website, hopefully by tomorrow. So if you have to hop out for one reason or another, no worries. We'll be able to get it up. You'll be able to watch the recording and get any information that you may have missed. Number two is there will be a Q&A session at the end of the program. So you can lob your questions in using Zoom, where you see the Q&A option in your Zoom menu, and we'll respond to those. If we don't get to any of your questions, you can email me at information@larcanalytics.com, LARC analytics.com, and I'll send out responses to anything we don't get to. Third and finally, we're going to get this question probably 5 more times throughout the webinar. I'm going to say it now, and hopefully it will register with most people, but you never know. Everybody that is in attendance will receive an email from me later today with the slide deck. So you don't need to ask about whether we're going to send out the slide deck. You will get it. With that being said, we're going to go ahead and get started. A lot to cover today. So maybe there it goes. So this is our agenda for the day. I'm excited to share with you something new, which we call LARC GIS. Some of our existing clients are already familiar with this. But most people that we don't work with on a regular basis now are not. This is a new product that we're going to roll out in really a week, next week. So we're pretty excited about it. I'm going to share a little bit of that with you. We're going to walk through the U.S. market review, where things have been, where they are right now, why this cycle is a little bit different. We'll dig into the economic outlook and some of the other non-economic data points that we're paying close attention to help formulate our outlook for 2023. And then we're going to dig into our U.S. lodging outlook. We'll focus on the top line first, and then we'll focus on the bottom line of values. And then we'll get into specific market highlights and markets that we like and markets that we don't like. So with that, let's jump into LARC GIS. And I am going to share a video real quickly. Hopefully I don't mess this up.
LARC. Better lodging analytics for better business decisions. We proudly introduce LARC GIS, the first of its kind GIS tool for lodging that quantifies the quality of any hotel location. Before now, hotel investors and developers were forced to rely on qualitative information about the strength of a given hotel location. Now, from your own desktop, you can get real data informing those decisions, down to the street corner. LARC GIS incorporates every major category of hotel demand driver, easily viewed, analyzed, and downloaded, right at your fingertips. And the best part? We aggregate all the data into one simple, easy-to-understand metric we call the LARC score, evaluating each location opportunity for instant decision-making potential, forever changing the future of hotel underwriting. Better data in, better data out. Go to larcanalytics.com/GIS to find out more.
All right. Hopefully you guys enjoyed that. Something a little bit different. We're pretty excited about it. And I think most of our clients have been very excited about it. We are going to host a live demo next week, I think Thursday at 1 p.m. And I have just now posted a link to register for that demo if you're interested in learning more about LARC GIS, which we think is going to really change how hotels are underwritten. That being said, we're going to go ahead and jump into our market review. So U.S. market review. We think about where we are and where we've come from throughout the course of this recovery. Obviously, RevPAR has snapped back pretty strongly from the depths of the pandemic. What I think is really interesting to highlight are a couple of points. Number one is if you go back to December of last year, December 2021, excuse me, RevPAR was 5.2% above 2019 levels. But then in January, the deepest impacts of the Omicron variant were felt. And RevPAR actually fell to 13% below 2019 levels. That was basically an 18-point swing from December to January. Overall, for the first quarter, things recovered more quickly, and you can kind of see from January, things bounced back relatively quickly in February and then March. And 1Q overall was only down a little over 1% relative to 2019 levels. So it wasn't terrible in the first quarter, but it was much softer than what we saw in the fourth quarter and leading into the first quarter, and certainly much softer than what we've seen throughout the rest of this year. And one of the things that's really interesting is, as of October, the trajectory remains promising, right? ADRs are 17% above 2019 levels. RevPAR is 14% above them. I think we're averaging around 15% over the past couple of months above 2019 levels on RevPAR. And you're going into the first quarter where we're going to be comping against a really soft comp from Omicron, where we were 1% below 2019 levels. So basically, even if we don't see a continued improvement in trends like we have been, and again, we have been seeing a continued improvement in trends, even if that pauses over the next few months, you're still looking at close to a 20% increase in RevPAR on a year-over-year basis in the first quarter. And that's something that I think is very promising. It's encouraging when you think about 2023 metrics. It certainly impacts our forecast pretty substantially. And one of the reasons why we are one of the more bullish forecasters out there for the hotel industry right now. Let's talk about the market specifically, and if I go back to 2021, and I point to this all the time, this has been such an inconsistent recovery. In 2021, US RevPAR was 17% below 2019 levels, but you had markets like Mobile that were over 20% above 2019 levels, and then markets like San Jose, San Francisco that were over 60% below 2019 levels. If you fast forward to 2022, and now we're using 2022 estimates. We obviously don't have final data for 2022, but so much of 2022 is now complete that we feel pretty confident in our estimates, and there's not a lot of there's not a lot of movement in them. RevPAR is going to be up 8% this year relative to 2019 levels. And now 33 of the 49 markets that we track on a quarterly basis are going to be higher than they were in 2019. That's up from 8 a year ago. But the divergence is still extreme among the markets. You got markets like Mobile and Palm Beach that are close to 30% above 2019 levels. And then you've got markets like San Francisco, San Jose that are down, that are 30% below 2019 levels. It's a 60-point variance. It's massive, which is one of the reasons why understanding the markets is so important, especially right now and where things are going. If we switch over to ADR, you're going to see a very similar story, just a little bit better. The numbers aren't quite as bad as RevPAR. US ADR was 5% below 2019 levels in 2021. Only 7 of our 49 markets were positive. Big divergence again. Miami at the high, 15% above. Puerto Rico 15% above. San Francisco close to 40% below 2019 levels. And then we fast forward to 2022 and where our estimates are now, same type of thing. US ADR is going to be 13.6% above 2019 levels this year. 31 of the 49 markets that we track are above 2019 levels. And market divergence remains extreme. Got a bunch of markets up over 20%, Palm Beach up over 30, and you've got several markets down over 10% in ADR relative to 2019 levels. So again, this just kind of points to knowing your markets is really important. It's not a one-size-fits-all approach. As we move back out to the national level and you look at air traffic and TSA throughput, I think the one thing that I think is important to highlight right now is that obviously things were recovering pretty nicely. Hit a little bit of a speed bump related to Omicron here, bounced back by mid-April of this year, and basically from mid-April all the way up till now, the end of November. There hasn't been much movement in TSA throughput. Maybe it's ticked up slightly, but you see some peaks and valleys related to holidays and calendar shifts. But for the most part, it's hovered just above 90% of 2019 levels, or down 10%, this line right here. It hasn't really moved a lot. And that's not that encouraging for continued growth, right? It kind of feels like air traffic is relatively stable. If you look at hotel booking data from SiteMinder, you get the same exact story. Basically, since April of 2022, bookings have hovered between 90 and 95% of 2019 volumes. So we're just not really seeing any big uptick from a room night sold demand perspective, whether it be air traffic or, excuse me, or from actual forward bookings. Just something to keep in mind right now. Booking windows are starting to lengthen, but they remain extremely short. Now, why is this cycle different from past cycles? Let's first talk about how it is different, right? This is the occupancy recovery with the dark blue line that you see right here, effectively being the current cycle, and the dotted lines prior cycles. Not surprisingly, occupancy fell much farther, recovered much faster. And right now we're kind of hovering right around where the other cycles were at this stage. So to give you some perspective, following the GFC, it took 81 months for trailing 12-month occupancy to recover back to prior peak. Following 9/11, it took 65 months. It's now been 41 months as of October. And the occupancy recovery continues to move forward. Pace, as I said, the slope of this line is starting to moderate a little bit. And occupancy on a trailing 12-month basis is still 5.5% below 2019 levels. But realistically, even at the front end of the recovery, if you end up being closer to the 9/11 recovery, you're talking 2 more years before occupancy on a TTM basis gets back to prior peak. And we're not sure it really ever does, and we'll get to that in a minute. When you think about it from an ADR perspective, I always find this chart really interesting because you see a few different things. Number one, obviously ADR fell much further during this cycle than the others, has recovered much faster than any other any other time as well. And what's nice is it's really continued to just generally move. You see over the past couple of months, it may have slowed slightly, but that slope of that line is still really strong. You know, to give you an idea, following the great financial crisis, it took 52 months for ADR to get back to prior peak on a trailing 12-month basis. Following 9/11, it took 45 months. It took 25 months this cycle. 25 months, considerably faster, you know, roughly 2 years faster, 1.5 to 2 years faster than prior cycles. Part of that's inflation driven. Part of that is probably because this was more of a healthcare related lodging downturn than a recessionary downturn. Both of those components weigh into it, but nonetheless, the important thing here is that ADR is continuing a pretty strong trajectory. And then if you think about RevPAR, the combination of the two, following the great financial crisis, it took 59 months for RevPAR to get back to prior peak on a trailing 12-month basis. Following 9/11, it took 52 months. In July, which was month 29, trailing 12-month RevPAR exceeded the prior peak levels. So there you are, considerably faster than prior cycles. And as of October, we're running close to 6% above prior peak levels on a trailing 12-month basis. So we've certainly seen a faster recovery on ADR and RevPAR. Occupancy, you know, the slope of that line was faster. It started to level off, and now it's similar to what we've seen from past cycles. When we think about values, I'm going to focus on the kind of the historical right now when it comes to asset values, and we'll worry about the forecast for those shortly. But, you know, following the great financial crisis, hotel values dropped 27% from peak to trough. You know, and it didn't recover again for 8 years, from 2007 until 2015. So, you know, you saw a massive, you took a lot of time to get back to that prior peak. But then they continued to grow, and by 2018, values were 18% above the prior peak. Here, this cycle, values started declining in 2019. We estimate they dropped a little over 20% in 2020, but they started to bounce back pretty nicely in 2021, and they were, you know, only down, you know, somewhere in the ballpark of 6% for 2021 relative to 2019 levels. And we actually think 2022 values, despite challenges over the past 6 months related to the capital markets, generally recovered to 2019 levels, though not in every market. This is kind of a really interesting chart that those of you that saw our client letter probably might be familiar. But it's one of those things that I really want to highlight to people today is this idea that, there is a lot of talk in the marketplace. I have this conversation with my clients all the time, with other analysts, other people that we talk to, that this idea that, well, lodging has bifurcated from the economy. GDP was down, in the first quarter and down in the second quarter, and lodging fundamentals continued to be super strong, and therefore they can continue to be super strong in 2023, even if we're in a recession, right? I hear this time and time again. The reality is, across the country, lodging fundamentals have not bifurcated from the economy at all. The reason why people think that it has is because the economy, if you measure it in the form of GDP growth, is measured differently than how hotel fundamentals are measured, right? When you hear about GDP being up 1% or down 1%, it's based on a quarter over quarter metric that's annualized. So 2Q over 1Q annualized. When you talk about RevPAR or lodging demand growth, it's on a year over year basis. So you're taking 2Q22 over 2Q21. It's not the same comparison. So you end up with, so if you're trying to compare RevPAR growth to the GDP headline growth metrics, you're comparing apples and oranges. If you adjust the GDP data, not for the year over, not for the growth metrics that get printed in the press, but actually the actual GDP on a year over year growth basis, you see a very, very different story. And that's what this shows here. The dashed line here is GDP growth on a year over year basis, historically, as well as moving forward. If you go back to, earlier this year, you actually saw pretty strong GDP growth in 1Q and 2Q relative to the prior year. And that helped fuel RevPAR and demand. And if you look over here, from 2000 to 2019, the correlation between GDP and demand was about 75%. So RevPAR was about 80%. Well, from 2020 to 2022, now granted, it's only 11 quarters, so it's limited data points, but the correlation's even higher. It's 97% for demand and 93% for RevPAR. The R-squareds are higher as well. So I think this makes the argument that the industry is still highly related to economic activity and economic growth. It's just about being able to understand how to look at things to make the informed decisions, which is one of the things that we try to do here at Lark. Now I say that, that the national recovery has aligned with economic growth, and that's true, but it's not true at the market level. And that's one of the things that's really cool. At the local level, it's really decoupled. So if you go back, you look from since 2019, the demand growth right now is what we're looking at, is the dark blue, and market level economic growth is the light blue. You can see how those lines look nothing like one another. You've got a market like this, Austin, where strongest economic growth, and towards the bottom in terms of demand growth from 2019 to 2022. You can see others. Here's San Jose right here. Then you've got others that are relatively low in terms of economic growth, but actually have decent RevPAR. It really does. The reality is the relationship has not held across the markets. There's a 14.5% correlation here versus historically it's been closer to a 42% correlation. So that's a big drop off in terms of how the GMP driving demand. And if you look at it on a RevPAR perspective, you're going to get the same exact result. The correlation here is just 0.2% now since 2019 versus a little above 42% pre-pandemic for the 20 years prior to the pandemic. And again, you're looking at dynamics here where you've got markets that have performed fairly well from an economic perspective, but it doesn't necessarily show up as much in terms of the RevPAR. And then you've got markets that have been underperforming on economic perspective, but are holding up all right in terms of RevPAR. And I think that's just kind of the point that we're trying to make here, is that nationally, the industry has not decoupled from the economy, but locally, the local industries are there's more factors driving local demand than just basic economic activity. And if all you're doing is focusing on basic economic activity, you're going to end up making the wrong call and investing too much in a market that maybe not be as strong going forward, because you're focused on the factors that aren't really driving hotel demand and hotel RevPAR. and there's lots of examples of it. I don't want to, go too deep into this, but that's why it really comes down to understanding what the real drivers of demand are, what the real drivers of pricing power are, and they're not the same from one market to the next market. Understanding those nuances is what we do. So let's talk a little bit more about kind of the macro outlook. There's economic factors here as well as some factors that are more relevant to lodging, if you will, and not as much macroeconomic. First one being, the return to office. As I'm sure everybody on this call knows, office utilization remains very low relative to 2019 levels. Data from Castle Systems basically says that, office utilization rates, have hovered around, under 50% of 2019 levels, for several months. Growth has been very limited. It's picking up a little bit, but it's pretty limited. I mean, this slope is going to take forever to get back to 100, and I'm not sure that it ever does. So I think it's just one of those headwinds for corporate transient. If people aren't in the office, then there's fewer reasons to go travel to see them in their offices. So it's a headwind for corporate transient. There is a strong relationship between office employment, which obviously office utilization is a new dynamic tied to that, and corporate transient travel. So it's a concern that we continue to expect to proliferate into 2023 and beyond. Second point related to corporate travel. The outlook for corporate profits in the stock market isn't exactly bullish right now, right? Corporate profits from Moody's are projected to decline 4% in 2023 before modestly increasing in 2024. That sounds really negative, right? Oh, they're going to be down. That's terrible, right? That means corporate transient is going to be down. And not necessarily, right? So what's kind of interesting here is that while corporate profits are projected to decline by 4%, they're also still expected to be about 30% above 2019 levels in 2023. Stock market's down 14% year to date. Oh, that sounds terrible. Still almost 30% above year-end 2019 levels. So when you're comparing corporate profits and stock market and other factors that often have an impact on corporate transient and companies' willingness to spend money on corporate travel, if you're comparing it on a year-over-year basis, you're going to things aren't going to look great, right? But if you're comparing it to 2019 levels, oh, there's a ton of upside, and the corporate travel hasn't recovered to those 2019 levels yet, right? Let alone to 30% above those 2019 levels, like the stock market has and corporate profits have. So in our view, on a normalized basis, if corporate profits were at a normal, or if corporate transient demand was at a normalized level in 2022, I'd be worried about corporate profits declining and where the stock market is. In an environment where we think corporate transient travel is still 20% below where it was in 2019, I'm not as concerned about that. I think, does it weigh on the growth trajectory of corporate transient demand? It absolutely does, but it doesn't turn the growth trajectory in a different direction. You're still in recovery mode. And that should lead to continued expansion of corporate transient demand in 2023. Moving on to leisure. Leisure, on the flip side, I get a little bit more concerned about right now. So one of many data points that we track related to leisure demand is the U.S. personal savings rate. There's historically been a very strong relationship between the ability to spend and the propensity to travel from a leisure perspective. And what you saw, coming out of the pandemic was a spike in personal savings rate that was tied to fiscal stimulus, right? And what happened immediately after? You saw unprecedented levels of leisure transient demand. The U.S. personal savings rate on average was about 2 times what it was going into the pandemic as at the end of 2020. And then you had a little bit more stimulus and things went back up and more travel. Unfortunately, that has now all been spent. And on top of that, you've had elevated inflation and costs of living are going up. And as a result, personal savings rates are now down to the lowest level they've been since 2010. And that is concerning from a leisure travel perspective, the willingness and propensity for people to spend money on leisure travel. I'm not saying it's going to go away. It's just, it is a big red flag for leisure travel. Moving on to group. one of the things that's kind of interesting related to the group segment is where convention center bookings are. We've aggregated definite room nights from over 30 convention centers around the US. And what's kind of interesting when you look at 2023 data is, on average, convention centers are pacing up 13% over 2022. So you've got group demand that's going to grow in the double digits. It's going to help with pricing power. It's certainly going to help a lot of the urban markets, where most of those convention centers are. And you still have more upside from there because you're still 9% below 2019 levels in 2023. 2024, we estimate that bookings are down a little bit, which is a little concerning, but there's time to make up that gap. So while normally, big group would take longer to recover, it's happened very quickly here, partly because this was more of a health-related downturn than an economic downturn. But I think these data points are very encouraging when it comes to group as we think about 2023. The one thing that I'll mention real quickly on this is, the fiscal stimulus. I talked a little bit about it related to the leisure transient dynamics. As a nation, the U.S. invested a tremendous amount of money in fiscal stimulus packages, over 6 times the amount we ever spent before. And even as a percentage to GDP, you're talking about almost 6 times as much. So this is a crazy number. And unfortunately, what I equate it to is, where I equated it to 2 years ago when we were doing this was borrowing from the future to support the present. Well, guess what? That was 2 years ago. Now we're in the future and we have to pay it back, right? And part of that is in the form of inflation that we're seeing, and part of it's going to be a variety of other factors that are going to be that are going to limit economic growth over the medium term. So that can be somewhat concerning. It's not the end of the world, but it's just something to keep in mind when you think about being overly aggressive. Now, when we think about our broader U.S. economic outlook, and I'm not an economist, I don't claim to be an economist. We rely on Moody's Analytics. Mark Sandy's company used to be known as Economy.com as the economist that we trust and leverage. And basically, the underlying assumptions right now for the industry, and the nation as a whole are, relatively muted. GDP did accelerate in the third quarter. So we saw positive GDP growth for the first time this year, but Moody's is expecting it to be slightly negative in the fourth quarter. And 2023 is going to only see GDP growth of 0.7%. Unemployment rate is going to gradually tick up through the middle of 2024, where it peaks north of 4%. Inflation, good news is Moody's expects inflation to continue to moderate, drop below 4% by 2023. Interest rate hikes will continue. Moody's expects 50 bips later this month, another 25 bips in the first quarter, and the 10-year Treasury yield to peak around 4.6% in the middle of 2023, about over 100 basis points above where it is right now. You put all that together, and you've got a brief, mild recession. And that is our baseline assumption, is that there is a very brief, very mild recession. Now, could that brief, mild recession turn into something more extreme? Yeah, and it's going to be driven by these factors. COVID-19 variants that we're not expecting, inflation that doesn't continue to moderate as it has over the past couple of months, and interest rates that continue to move higher, and the Fed keeps their foot on the gas longer than we currently expect. And those are all factors that will lead to a worse economic growth environment than our baseline scenario. As we dig in, let's talk about inflation. So here you'll see Moody's forecast as well as the Wall Street Journal consensus forecast. The good news is everybody basically thinks inflation peaked and it's going to continue to come down. And Moody's is pretty low relative to the Wall Street Journal numbers. I hope Moody's is right. I don't know, but bottom line is, even if you just fast forward to June, they're not that far apart from one another. And when you get further out, they're very close to one another. So bottom line is, inflation looks like it is pulling back. That's a positive, and that's going to help from an economic growth perspective. The negative is interest rates. All right, the Fed's been super aggressive in raising rates, 375 bips year to date, historical increase. And rising interest rates are going to slow economic growth. There's just no way around that. The hope right now is that inflation will moderate or continue to moderate. And as that happens, the Fed will be able to be less aggressive in interest rate hikes moving forward. Like I said, our underlying assumptions are 50 basis points this month and 25 basis points in the first quarter. To the extent that the Fed keeps their foot on the gas and they stay hawkish for too long, tightening monetary policy past what we call the point of equilibrium, that will send the economy into a deeper recession. Given the Fed's comments related to trying to be very aggressive relative to trying to break the unemployment levels, it's a real risk and it's a concern. And we don't want to sit here and tell you, oh, the recession is going to be super mild. Don't worry about it. Our assumptions and what goes into our models is that it's not going to be that bad, and it should be pretty mild, but there is risk that it's much worse. So it's just something to keep in mind. And the real reason why it's going to be much worse is primarily going to be driven by the Fed, and the Fed being too aggressive for too long, because unfortunately, the Fed looks at a lot of metrics and many of them are in arrears. So if they continue to act on data in the past, then it can lead to overreaching. And that's the concern that we have. So when you think about our broader assumptions related to our US lodging forecast, generally we say the Fed will raise rates by another 50 basis points this year and 25 early next year. Inflation will moderate to under 3%. Labor supply constraints will begin to ease, but wage growth remains in place. There's no new variants impacting children or the vaccinated in any meaningful way. Russia-Ukraine conflict will continue, but there won't be any military involvement from the US or the rest of the West. And as a result, the US is on the brink of a brief mild recession, which we expect to materialize either late this year or early next year. So let's talk about lodging fundamentals. What does all that mean, right? What you're all here for. Well, to talk about lodging fundamentals, I think it makes sense to talk about the demand segments. I walked through corporate, group, and leisure a little bit ago in terms of what's driving some of our views. This gives you an idea of what our demand segment recovery looks like. On our metrics, and these are estimates, we estimate that corporate transient demand was about 2/3 of 2019 levels in 2021 and rose to about 80% of 2019 levels in 2022. So you're talking about corporate transient demand that is still 20% below 2019 levels. So there's a significant amount of recovery that has to continue to occur. Of course, what doesn't have to, but that could continue to occur across the corporate transient segment, which is why we're not as worried about the declining corporate profits, stock market, things like that. Now, that being said, we also don't think corporate transient ever fully recovers to 2019 levels. We think office utilization rates will never get back to those levels. That's going to truncate the number of nights that people go on the road to meet with their clients to fewer days. That creates, fewer room nights and shorter trips for corporate transient, which unfortunately will reduce corporate transient demand. But the good news from that is it also could create more compression and more pricing power. It will also translate into, in our view, more group demand. And the reason why we say that is because if corporations don't have people in the office 5 days a week together, they're going to try to get their teams together in other ways. And that's going to be at conferences or offsites or other things along those lines, which are going to drive group demand a little bit higher. In 2021, group demand was about half of the levels that it was pre-pandemic. This year, we estimate it was off by about 15% from 2019 levels. We think it's going to snap back pretty strong. We're pretty encouraged by the data that we see from group, and we generally think it will stabilize about 10% above where it was in 2019. And then last, leisure. If corporate is not in the office 5 days a week, there's this opportunity for you to start to travel and do more long weekends, get away, work remotely, similar to what we've seen over the past couple of years. I think that's going to continue. The challenge is going to be, it's probably not going to continue at the level that it's been at, right? We estimate that in 2021, leisure demand was 75% above 2019 levels, almost 2 times more leisure demand, room nights sold, than there were in 2019, right? That moderated a little bit in 2022, but it was still higher than we had really thought, frankly. But as you move forward, that's going to continue to dissipate, and we think it's going to stabilize around 30% above 2019 levels in 2023. When it comes to supply, our views on supply are pretty positive. Things are looking really benign. Do we think supply growth is going to pick up modestly on an economic basis in 2023? We do. We think it's going to go from 1.1 to 1.6. That's a modest increase. And on an aggregate supply, when you're not adjusting out the temporary closures, you actually see a declining supply from 2.4 to 1.6. That's the difference between these two supply metrics. Top one incorporates temporary closures. The bottom one adjusts out all the temporary closures. The other thing that I'd highlight about our supply outlook is that we have pushed out a lot of hotels in planning to 2026 and 2027 in our models, because ultimately we don't, based on what's happened over the last 6 months in terms of, and what we think is going to continue to happen over the next few months related to construction financing, you're just not going to see a lot of these hotels that are in planning start construction because the financing isn't going to pencil out for them yet. I think it will at some point, but not just yet. So we actually see supply growth continue moderating from 23 to 24, and then again from 24 to 25 before it starts to accelerate again in 2026. But ultimately, we're talking about very benign supply growth, below national averages basically every year for the next 5 years, or historical averages, I should say. So here's our RevPAR model. I don't want to spend a ton of time on this, but if people have questions, you're welcome to ask. But basically, our approach to forecasting is doing multivariate linear regression forecasting. The dark blue line in the chart you see right here is historical RevPAR data for the US from STR CoStar going back to 2000 on a seasonally adjusted basis. The light blue line is the model that we have built. We've built that model to forecast RevPAR historically, as well as forecast it going forward. You can see how accurate that model has been historically. It actually has an R-squared of 99.5%. I'll also tell you the primary drivers of our model right here: unemployment rate, GDP, business investment, and foreign exchange rate. There are a lot of other drivers too, but these are the 4 primary factors that really drive our model and make and move things the most. Other factors do come into play. We look at a lot of different variables. ADR, same thing, 98.7% R-squared. Key model drivers over here, they're a little bit different. It's important to pay attention to that stuff. And you can see how accurate that model has been historically as well. With our RevPAR and ADR model, we back into occupancy. And here you see our occupancy forecast, looking out to 2026, ADR, RevPAR as well. And you can see how we stack up relative to the other major forecasters out there based on what's been available publicly. And a couple of things that I would highlight about our forecast is, we expect occupancy to increase in 2023 from 63.0 to 63.9%. That's about a 1.5% increase in occupancy. ADR is going to grow to, ADR is going to increase 5.3%, and RevPAR 6.8. We are the highest of all these forecasters in terms of RevPAR growth at 6.8. I think PwC is second, which is somewhere around 5.5%. Some of the other guys are much more conservative than us. We don't think that makes sense based on the comps that we see in the first quarter related to Omicron. But generally speaking, our view is we don't think we're being bullish at all. And we have a lot of reservations regarding the growth profile of the sector right now. But when you look at what's happening right now, we've got strong growth in the first quarter, but then we're looking at 3 to 4% growth in 2Q and 3Q. And then we've got flat to slightly negative RevPAR growth in 4Q. Those metrics don't seem to be overly aggressive to me by any sense, yet we're by far the highest in the group. So I think that's kind of interesting. The other thing that I'd highlight is that we generally think occupancy is going to stabilize in this 63 to 64% range throughout this cycle. We don't think occupancy is going to continue to tick back up and ultimately get back to that 66% level that we saw in the last cycle. That is a different view than what you obviously see from STR or CoStar. We think we're right. We just don't think you're going to see the same level of corporate transient demand, and that's going to limit things. Now, question is, okay, that's great. There's your forecast. You're more bullish than everybody else. Why should I trust you? Well, you should trust us because we've been more right than everybody else. This is data this time last year, looking at 2022. And you can see where everybody's forecasts were as well as what the average of those forecasts are now for 2022. Now, again, 2022 isn't final yet, so I just took a basic average of all 5 forecasters and you get the numbers. And at the end of the day, we were as close as anybody, if not closer, on occupancy. We were by far the closest on ADR and by far the closest on RevPAR again. And if you think that's odd, or maybe it was anomalistic, here's the same data a year earlier, the end of 2020 for 2021. Again, we were by far the closest. Doesn't mean we're always right, but we are more right than everybody else, which tells me that our approach is working to an extent. And the reality is, if we're more close to the national level and we spend most of our time at the market level, we're going to be a heck of a lot more better at the market level, which is what we tend to focus on. So that being said, let's move into some of the price classes. And we forecast by price class, not by chain scale. The big difference between that is price class includes independent hotels that are competitive at that with the branded properties in that segment. So here we're looking at year-over-year growth in 2022 and 2023. And I'm going to focus my comments on 2023 because I think that's really what people care about. We actually see the strongest growth at the high end, right? Upper upscale up 15% year over year, luxury up 9%, upscale up 12%, and then the low end is much lower, mid-scale flat, and economy up 3%. You know, and one of the reasons for that is that the group segment, the group segment is particularly strong. We see group and corporate transient recovering. That's going to benefit these segments more. We see the leisure segment struggling to an extent, which is going to impact these segments a little bit more, which is why we're a little bit more optimistic here and less optimistic here. If you fast forward that data and just focus on 2019 relative to 2019, you see a bit of a different story here. And I'm going to focus on the 2023 metrics. So luxury is going to be the strongest, right? Next year, we expect luxury, which has already been pretty close to the economy, mid-scale, and luxury have all performed really well relative to 2019 levels. But it's obviously very different drivers, right? We think the drivers that drive luxury and the pricing power that you see in luxury is going to continue to hold, and you're going to see continued growth in 2023, which is going to drive that to be the highest. Upper upscale is a segment that has really lagged everybody else, right? But it's also the segment that's most exposed to group. Group is the segment that we think is going to shine in 2023, and you're going to see the outsized growth, which is going to help drive that business right there, recovering back to on par with where a lot of the other segments are. Upscale will benefit as well. We are much more cautious in the low end. Economy, we think, will hold up a little bit better than mid-scale, just because of the the lower price point typically is a little bit more resilient during periods of economic stress, like we think we're going to embark in early 2023. So that gets us a little bit more bullish there. But bottom line here is, as you think about it from a relative to 2019 level, we really like the luxury segment. Relative to 2022, we really like upper upscale. But we also think that there's several segments there that are going to continue to perform pretty well. All right, let's move beyond the top line and start to focus on the bottom line. So a few assumptions. We estimate property taxes across the country are going to grow at a 4.5% compound annual growth rate through 2026. That's similar to where we've had it before. There's a lot of moving pieces tied to that. There are certain markets that are going to see very low growth, others that are going to see exceptionally high growth. And we can talk about some of those in a little while. When you think about wages, which is really important, obviously, Moody's expects hotel industry wage growth to be up 10% on a year-over-year basis, which is pretty crazy. So we're going to see massive growth in terms of wage growth in 2023. It's really a lot of catch up from the inflation that we've seen over the past 18 months starting to materialize in wages in 2023. The good news is it will start to moderate in 2024, and then we'll be right around that 4 to 5% level thereafter. Ultimately, over the next 5 years through 2026, we expect a 6.2% wage growth CAGR. So what does that do to hotel EBITDA in general? Well, we estimate that hotel EBITDA is back to 2019 levels this year, slightly above them, just ever so slightly. We'll continue to grow next year. And then it's going to kind of plateau in 2024, 2025 before declining slightly thereafter. Let's talk about cap rates. We spend a lot of time with our clients talking about cap rates. And there's a lot of noise and a lot of, you can pick and choose data, and data points are limited. The reality is, similar to inflation, we don't really have good data on periods of rising rates for where hotel cap rates have been. If you look at CoStar data or RCA data, it doesn't go back to the 70s and the 80s when you saw rates rising, cyclical rates really rising pretty aggressively. So it's hard to really pull data to make it that accurate. But intuitively, there's a lot of things that we can talk about. But if we just focus on the data that we do have, what I can tell you is really fascinating, which is there is almost no relationship between the 10-year treasury yield and hotel cap rates across the US. There is a 0.1% R squared and a negative 3.4% correlation. The change in hotel cap rates is not impacted by the change in 10-year treasury yield going back for the last 22 years. Even if you try to smooth the data on a rolling 4-quarter basis, same thing. You don't have a relationship. And the reason being is that the hotel cap rate is composed of two components, right? You've got the base rate level, and then you have the spread or the risk premium related to that base rate level. And when you've got that spread, the spread is basically the risk premium. Spreads are moving higher when there's more risk and moving lower when there's less risk. And that is the exact opposite of what typically happens with base rates. In a normal environment, interest rates, the 10-year treasury yield will move up when there's less risk, and move down when there's more risk. And these are fascinating dynamics. They work in opposite directions. And what's crazy is it's almost identical in magnitude. So if you look at the change in cap rates relative to base rates historically, or change in spread relative to base rates historically, you can see how historically they've almost moved in the exact opposite directions from one another. In fact, there's a negative 97.5% correlation between the change in treasury yields and the change in spreads. So if you flip this around and just go invert the spread so they look like they're on top of one another instead of you see exactly what I mean right here. But that's really interesting. So why isn't that showing up in the numbers today, right? Why are spreads higher? Well, for the first time in almost 50 years, interest rates are rising during a period of increasing economic risk, right? We talked about the fear of recession, the likelihood of recession over the next 6 to 12 quarters. I think the October survey from the Wall Street Journal indicated that 68% of economists expect that there will be a recession within 12 months. Yet the Fed is being aggressive with rates. It usually goes the exact opposite way. They get more dovish, but because they were in such a hole early on, it became a little bit trickier to do that. So they had to be more aggressive. Now you have base rates rising while economic risk is rising. Ultimately, what is likely to happen is that the macro environment will stabilize over the next few months. And when that does, you will see base rates start to stabilize. And more importantly, you will see spreads start to compress as there will be more clarity and less risk. However, until then, spreads are likely to remain wide and cost of capital is likely to be elevated and challenging environment for deals. So with that backdrop, here's our cap rate model. Looks just like the other ones, 98.4% R squared. Factors that drive it: bond yields, high yield bond spreads, foreign exchange rates, GDP, unemployment rate, supply, et cetera. And it's basically telling you that cap rates are going to roughly stay where they've been. You're not going to see them peak back up to kind of GFC levels in close to 10%, but they are going to start to dribble up towards the latter end of our forecast, rising modestly. Put all that together and you get our overall US forecast. And the key highlights that I'll give you from this page are real simple. For 2023, ADR is up 5.3%, RevPAR 6.8%, but hotel EBITDA is only going to be up 8.8%. That's way lower than we would normally like to see EBITDA flow through relative to top line growth. And that's just largely driven by the rising wages. Now, I think there are going to be sectors like those big group oriented houses that benefit a lot from added food and beverage are going to do a lot better than that. And that's going to be positive for them. But across the industry, we're looking at about 8.8% EBITDA growth in 2023. And we expect cap rates to modestly expand, as you guys all heard us talk about, and with where things are going over the next 6 months until things stabilize. So we're not going to see an 8.8% increase in values. We estimate about a 4% increase in values. And if you look out 5 years, ultimately, we've got values up roughly at a 3% CAGR. Hotel EBITDA is going to grow a lot faster, but a lot of that growth is fueled by 2022 numbers. We walked through kind of where hotel EBITDA on an annual basis was growing before. And how have our numbers changed relative to a quarter ago? Not a lot different. The real change is that, as I mentioned earlier, leisure demand surprised us to the upside this year. And as a result, our occupancy is a little bit higher. It's flowing through to RevPAR and thus hotel EBITDA. But it's being offset on values by cap rates that have moved higher because of what's happening with interest rates and general and deal volumes, et cetera. Now, when it comes to values, and we look longer term values, this is one of those slides that's always interesting to highlight. Ultimately, values have recovered faster than they did following the great financial crisis. We expect them to ultimately peak in 2025, about 8% above the 2018 peak. We think they get to the pre-pandemic levels. They already got to the pre-pandemic levels this year, we think. And they'll get to the 2018 peak in 2023. They'll then peak 8% higher in 2025. And then they're going to start to decline over the next couple of years, as you saw our EBITDA metrics pull back and cap rates modestly increase. So that's our view on where values are going to go over the next 5 years. Now let's take a switch over to our market outlook for a few minutes before we take Q&A. So these are the 50 markets that we issue reports on a quarterly basis where we're forecasting. We do a lot of work for other markets over the course of a year, but that's more of an ad hoc commission basis for specific clients and not some things that we maintain on a quarterly basis. So I'm going to focus on these 50 markets. When you look at our 2023 outlook, RevPAR growth for Lark's 50 markets, 2023 versus 2022. If you look at the left-hand side, strongest markets, San Francisco, San Jose, Houston, Minneapolis, DC, Seattle. These are all markets that really underperformed during the recovery to date, except for Houston to an extent. And Houston, we also think will really benefit from the strengthening energy industry. Houston also, comparing 2019, was not exactly a high watermark for Houston. So it's a kind of a low bar for Houston to be comparing against, which makes their numbers look pretty good as well when you compare against 2019. But overall, on a year-over-year growth basis, basically markets that have been underperforming will outperform. Markets that have been outperforming will probably struggle a little bit more, but not that much. Relative to 2019 levels, if you try to normalize out kind of the pace of recovery up till now, then and just say 2023 versus 2019, Palm Beach, Puerto Rico, Miami, Phoenix, Orlando are the five markets that we think will have the highest RevPAR relative to 2019. They're all leisure oriented. At the bottom end, despite the strength from San Francisco, San Jose, some of those markets here, they're all the way at the bottom here, where we're pretty cautious. San Francisco, San Jose, Portland, Cincinnati, Columbus. If we move on to a longer term RevPAR outlook, you'll see our favorite markets are markets like Las Vegas, Puerto Rico, Palm Beach, Tampa, Orlando. From a RevPAR growth perspective, we remain pretty cautious on San Francisco, Portland, Cincinnati, San Antonio, Louisville. All of them for slightly different reasons. But at the top end, what you'll see is that they're all very leisure oriented. We think that leisure will continue to shine. And a lot of the gains, while the growth levels from this point through 2026 may not be that robust, most of those markets have seen extraordinary gains to date in the cycle, and we think they'll generally hold those gains. So when you compare it relative to 2019, they look like very strong markets. And then when you think about values, looking out to 2026, our favorite markets are Puerto Rico, Tampa, Phoenix, LA, and Houston. And I'm going to spend a minute on each of these real fast. Puerto Rico, we think Puerto Rico is a totally misunderstood market. Strong leisure demand tied to the US as a feeder market. Obviously, there's concern that leisure demand will pull back across the US, across the US. That's true, but Puerto Rico has the benefit of being an easy destination, affordable destination, very accessible. And because it was it's a fly to destination, it doesn't have a ton of, it didn't experience the same level of pent up leisure demand at the start of the recovery that markets like Miami did. So think there's a lot of legs left in Puerto Rico. Number one. Number two is we think 2019 isn't really a great metric for a baseline for Puerto Rico because it had undergone roughly 10 years of natural disasters that kind of skewed metrics, which made things funky. But if you try to normalize for all those things like we do, we see a ton of upside to fundamentals and valuations. And the reality on valuation is one of the things that I think people don't pay enough attention to is there risk to natural disaster? Is there risk to natural disaster translating into, an energy grid shutdown and things like that? Absolutely. But you're buying at a 12 cap, and the reality is you can take 50 bips off your cap rate and buy a hedge against natural disasters from all kinds of different players that do that. And you now bought an 11.5 cap and took out the risk of natural disaster. So you're buying a luxury asset 500 basis points above what you'd buy it for in Florida. To me, that's a home run. And I think we're going to continue to see that unfold over the next few years. Tampa, a market we love. It continues to screen really well for us. There's massive real estate development reforming the urban core of the city. Convention calendar is really strong. Great beach areas. You've got the new high-speed rail train going to Disney that we think will siphon a lot of leisure travelers from Orlando to the Tampa beaches as opposed to the Atlantic coast beaches, which will be a big positive for Tampa. Phoenix, this is a market that continues to do well, strong economic growth, population expansion, lots going on, lots of leisure demand drivers. Market just continues to hum along and do really well. We continue to like it. LA is a funky one. There's a lot of noise surrounding LA. Let me be clear right now. I don't love downtown LA. I think downtown LA has some challenges. There's a ton of supply and not enough demand generators. But if you're looking at West LA, whether it be Hollywood, Santa Monica, Beverly Hills, or the East Side out to Inglewood, there's a ton of new demand generators that are going up. You've got the college football championship in January. You have the World Cup semifinals in 2026, and then the Olympics in 2028. You've got new infrastructure going in, whether it be massive airport expansion or public transit, you name it. All of this is going to help the market. Are there concerns surrounding property taxes in LA? Yes. The flip side of that is wages. LA raised wages, raised the minimum wage before the pandemic, if you all recall. So the wage growth in LA hasn't been anywhere near and is not looking to be anywhere near what you're seeing across other markets around the country. And then you layer in what's going on in the entertainment industry, all the studio development across the market. There's just a lot of economic activity for a market as mature as LA. Things look really, really strong. And then Houston, this is energy oriented. As the energy markets continue to improve, Houston will continue to improve. And like I mentioned before, 2019 wasn't exactly a high watermark for Houston. High watermark for Houston was 2014. So there's just it looks pretty strong relative to those metrics. And with that, just to give everybody an idea, we sell reports with more information than you care to read on every one of these markets. The price list is here. What I will say is the more someone buys, the more they save. And if we can be helpful in any way, please don't hesitate to reach out. And with that, it is now time for Q&A. Those of you that stuck around, thank you for listening to me for an hour. And now I'll take Q&A. Katie, you want to let me know what's going on?
You bet. All right, first question. What was going on to cause values to decline in 2019?
Sure. Occupancy started to decline. Occupancy started to decline in 2019. and hotel EBITDAs in general were declining in 2019. That's what caused values to start to erode.
Next one, for your US GDP graph, can you please remove the bar at the bottom in the template so we can see the x-axis timeframes? I think there was a
bar?
little like glitch on Zoom where there's a little blue bar at the bottom, but it won't be in the PowerPoint.
Oh, sorry if that happened in Zoom. We'll send out the slide deck so you'll get the actual chart. You'll be able to see it.
Ryan, how do you factor in the potential upside of Asian international travel, which remains very muted?
Yeah, it's a great question. So I think Asian international travel is very limited to certain markets. It tends to be more skewed to the West Coast, but certainly the East Coast as well. We factor in international travel through a variety of metrics. The most obvious one is looking at foreign exchange rates relative to different currencies. The second one is looking at foreign direct investment into the US. The third one is looking at various consumer confidence levels across different regions to give us a sense of where that's going. And we build all of that into our models. Yes, they're very muted and that's encouraging. But at the end of the day, for most markets, not all, but most markets, it's a very small component of the demand segment.
How severely will you see new supply growth decline given the high interest rate and construction price hikes?
I mean, it's a great question. And I think we're already starting to see it, right? I mean, I think a lot of projects that have been in planning have kind of stayed in planning. You haven't seen a lot of new starts materialize over the past 6 months. The question is, when do they start back up? My guess is it's probably going to be a few more months, but at the end of the day, regardless of, the interest rates and price hikes limit it, but developers are going to develop and they'll figure out how to do it. Maybe it's because they take a lower return. We'll see. Supply is going to remain muted for several years. Like we said, I mean, I think our supply growth metrics are just north of 1%. That's almost half of what it was historically. So it'll stay muted, but deals will get done and things will get developed. It's not going to be nothing.
Any thoughts on property insurance costs, particularly Southwest Florida post-Ian?
It's going to be higher, especially in Southwest Florida post-Ian, unfortunately. But we build out macro level factors related to insurance costs. And a lot of that is tied to a variety of factors. I don't have anything specific to Southwest Florida that I can share though.
Within Lark market research reports, will Lark break down operating forecasts, occupancy, ADR, RevPAR by hotel STR classification?
In short, no, we don't forecast occupancy, ADR, RevPAR by the different chain scales or price classes by STR. And there's a few reasons why we don't do that. The biggest reason for that is really just this idea that I don't think that those classifications make that much sense anymore. I have seen so many upscale hotels in the same brand family, a block or two away from an upscale hotel in the same brand family that runs at a higher ADR. And I think that hotels tend to operate much more on a location basis than on a scale basis. So I have found it to be less relevant. That being said, it is something that we do on a commissioned basis for clients. But the reality is our approach is extremely granular and very detailed and thus more accurate than what you see from other guys. So to do that for the 50 markets that we cover would add a tremendous amount of work that we're just not sure people would be paying for the value of.
The Baird STR index is down 8% year to date through November 17th, 2022. Why does Lark believe values will be up 12% in 2022?
Well, the public markets are not the best indicator of private market values. We have seen that time and time again. So I don't know that I would read into the stock market index as saying, well, that's what private market values are. But I think our metrics are driven based on what we've seen from actual transactions, what we see from cap rates that are out there, what we see from hotel cash flows, NOIs, EBITDA. And all of those metrics together. And if you take a look at all those metrics, you'll certainly see that values were very real, and we see it time and time again. I mean, believe it or not, 3Q 2022 was a massive quarter for hotel transactions. that was closings. A lot of those deals were done, were signed, sealed, and delivered, in the first 4 or 5 months of the year. But nonetheless, they closed in the third quarter, and that's when we see the data materialize. So, the STR data, the stock market data, I would say A, is forward looking, not backward looking. B, I would say it's not a great indicator of where private market values are. It never has been.
As it relates to occupancy declines in 2019, was that driven by demand slowing or a function of reaching the top of a cycle where there simply was more and arguably too much supply in some markets?
Well, if you look at it from a national perspective, I don't think you can argue that it was supply related. Demand growth moderated is what happened, and supply exceeded it. Supply still nationally was modest. We're still talking about 2% supply growth in 2019. It wasn't like, oh my God, supply growth is up at 4%. It's double the historic average, and therefore, demand can't keep pace. Demand growth started to slow, and while supply remained around where it had been, it outstripped it.
Thanks. This was useful as usual. If RevPAR is deflated, how close is 2022 actually to 2018 or 2019?
We haven't looked at it on a deflated level because I don't know about you, but I don't take deflated dollars to the bank. So I always think that some of those metrics are kind of more anecdotal and less relevant to an analysis of where things are going to go.
And as of right now, that is the last question we have.
All right,
Wait,
great.
Someone just sent one.
Okay.
How would midterm results can influence demand?
Midterm election. I mean, that depends. I mean, do we think that the federal government's going to do anything? There's not a lot that gets done in the federal government. What I would tell you when you think about midterm elections, and I talk about this for DC all the time, when you have a split Congress or you have a divided Senate, where you've got basically there's one more seat plus the vice president of the tie-breaking vote in favor of the Democrats right now, very little gets done. And one of the big challenges that you see in DC related to very little getting done really comes to, and I'll go ahead and stop the share now. Really comes to this idea that like budgets aren't going to get, budgets don't get approved. In DC, how many years since 2000 has the operating budget of the government not been approved by year end? Happens all the time now. Prior to 2000, it never happened. And now it's every year because the two parties can't agree on anything. And if they can't agree on anything, they can't do anything. And if they don't do anything, then nothing gets done. And you don't see any impact, positive or negative, on lodging demand or pricing power. And it's it's really bad for DC, which is you've got all the lobbyists and contractors that are hoping to get contracts, but they can't get a contract if the government budgets aren't approved. And if the budgets aren't approved and the spending isn't approved, and trying to avoid government shutdowns and things like that, it translates into a situation where none of those guys are going to go travel to DC and try and wine and dine and spend the money with the politicians to try to get those contracts. So it doesn't happen. So it actually weighs heavily on the DC market. The rest of the country, I don't think it has any impact at all.
Last question. Can I pay staff in deflated money?
Can we do what in deflated money?
Pay staff. Like your staff.
I do not believe so. All right, everybody. Thank you for joining. I hope you found it helpful. As I said, I'll send out the slide deck shortly, and we'll get the webinar posted on our website, hopefully by tomorrow. And if you need anything or have any questions, please don't hesitate to reach out. Thanks for joining.
Thank you, everyone.